Earlier this year, I put together a list of 5 tax strategies most small business owners overlook. We get a lot of traction on it and a lot of great questions from owners who said, "What about this and what about that?" Different things their friends bring up. 2 questions that kept coming up more than anything else. One, can I rent out my house for business events tax free? Two, can I actually pay my kids a real salary and get a tax break for it? Both are great questions, both legal, both ways. Most owners are leaving real money on the table. So I went back and I updated this video for August 2026. Same 5 strategies from before, plus 2 new ones, 7 in total. By the end of this video, you'll know which of the 7 most likely applies to your business and roughly what each one is worth in real dollars. Not theory, real examples from owners that we've helped. If you're a profitable business owner doing 500K to $50 million and you've ever finished a tax year feeling you seem to always pay more than it seems you should, I get that. That's what we do, financial planning, and we research tax strategies so much. There are many more complex tax strategy ways to save money, but these are very clean and won't get you in trouble if they are well documented. Let's hop into it. Strategy number 1, cost segregation. This is the one most business owners have never heard of, and it's the one with the biggest single year tax savings for the right businesses. The IRS lets you depreciate a commercial building over 39 years. 39. So if you buy a $2 million property, you're writing off about $51,000 a year for nearly 4 decades. That's great, but the thing is, the building doesn't work that way. A parking lot doesn't last 39 years. The specialized electrical doesn't last 39 years. The flooring systems, the land improvements, the specialty equipment inside, none of it lasts 39 years. So a cost segregation study is an engineering-based analysis that breaks the building into its component parts and depreciates each part over its actual useful life, 5 years, 7 years, 15 years, not 39. A 78 employee metal fabrication shop owner, let's call him Tom, had been depreciating his building the standard way for many years. The study reclassified about 30% of the building. Federal tax savings in year 1 was roughly $259,000, and then put the state on top of it. The total was over 400K. Tom didn't change a single thing about the building. He just stopped treating it as a 39-year-old asset like it was a 39-year uniform. Strategy number 2, R&D tax credits. Strategy number 2, research and development tax credits. When you hear R&D, you probably think of a pharmaceutical company engineer in a lab coat. That's not what this is. The federal R&D credit rewards everyday technical work. The IRS has a 4-part test to qualify. An activity has to be technological in nature, involve elimination of uncertainty, require a process of experimentation, and serve a qualified purpose. If your team does any of those 4 things, you likely qualify. A 29-person tool and die shop owner, let's call him Mark, thought he didn't do R&D. He does. Every job that involved solving a machining problem, iterating on a fixture design, or figuring out how to hold a tighter tolerance than he'd held before, that's qualified research under the IRS test. His credit, $174,000 federal, $58,000 state, totaling $232 for this year for work he had already been doing. And under the One Big Beautiful Bill Act, 2 things changed that make the credit significantly more valuable. 1, IRC Section 174A. You can now immediately expense 100% of domestic R&D costs in the year they're incurred. 2, qualifying startups, they can offset up to $500,000 in payroll taxes annually for up to 5 years with the credit. Even if you have no income tax liability, you can take it in payroll tax credits. Strategy 3, bonus depreciation on a section 179. Strategy 3 is the bonus depreciation in section 179. The One Big Beautiful Bill Act made 100% bonus depreciation permanent for qualifying property acquired after January 19, 2025. No phase down, no sunset. This is the most owner-friendly equipment riding environment in over a decade. Section 179 went up at the same time. For 2026, the expensing limit is 2.5 million with phase out starting at 4 million. So you can expense the full cost of qualifying equipment, vehicles, and facility improvements in the year you buy them. A regional manufacturer we talked to with owner name was Gary, was planning a $2.4 million equipment refresh. His previous CPA had been depreciating everything over 7 years. We moved the timing, layered in Section 179 for the smaller items, and used cost seg on a recently purchased facility. First year deductions, about 1.9 million. Same purchases, same businesses, or same business, just the right structure, or a better structure, let's say. Advanced retirement plans. This is strategy number 4. So number 4 is advanced retirement plans. The plan you set up 5 years ago is probably wrong for the business you have today. Most owners I work with opened a SEP IRA or solo 401k when they were small, just starting. Then the business grew. The plan never changed. Now they do, some of them don't even contribute. Here's what 2026 looks like. A solo 401k caps owner contributions at 72 to 80K with the 50 plus catch up. 83,250 with a Secure Act, super catch up if you're 60 to 63. Safe Harbor 401k with cross-tested allocations can push it up to 85 to 100K plus. And a cash balance pension plan layered on top can reach the limit of $290,000. Cash balance plans are age-weighted, so a 60-year-old can contribute much more than a 35 or 40-year-old. A 12-person professional services firm owner named Sarah came to us with a vanilla 401k from a payroll provider. The owner contribution limit was 30K. We redesigned with a safe harbor structure and cross-testing. New limit was $85,000 plus. Same cash flow from the business, $55,000 more in deductions per year. That's a 6-figure tax difference compounded over a decade. Strategy 5, entity structure and QBI. So strategy number 5, entity structure, and we'll cover Section 199A QBI deduction. S Corp you select in year 2 probably is wrong for the business you have today. And here's why. The QBI deduction lets pass-through owners deduct up to 20% of qualified business income. For 2026, the income threshold is $241,950 for single, $483,900, so basically $500,000 joint. But QBI excludes reasonable compensation paid to S Corp owners, and reasonable comp has crept up as the IRS has gotten more aggressive about flagging low salary, high distribution structures. A growing manufacturer owner named Paul talked to us about paying himself $80,000 in salary and taking $400K in distributions to minimize his FICA. QBI calculation exclude his salary. We modeled a C Corp election with a 199A plan style strategy, plus raised his salary to the defensible reasonable comp range. Combined federal savings, tax savings was 60K per year, and his audit risk dropped. So the lesson is the same one I keep coming back to. Entity structure isn't something you set up once and walk away from. It needs to be reviewed every time the business grows, raises capital, brings on a partner, faces a new tax law. Most owners haven't reviewed it since year 2. That's expensive. And always talk to your tax advisor, even if we have a good strategy, and make sure it makes sense. Strategy 6, Augusta Rule. Rent your home tax-free for business events or meetings. So strategy 6 is called the Augusta Rule. Many business owners have never heard of this one, and the ones who think of it think it only applies to homes rented during the Masters. It doesn't. The Augusta Rule is a provision of the tax code under Section 280AG, and it lets you rent your personal residence to your own business for legitimate business purposes up to 14 days a year, completely tax-free. No income, no reporting, no payroll. The catch is it has to be a real business purpose and rented at fair market value. You can't just pay yourself $5,000 for the weekend. The IRS wants documentation comparable pricing, and a real business reason. So client meetings, board retreats, you could have dinners, planning sessions, training days. Do those out of your home, and you can write it off. There was one owner based in Florida. His revenue was about 900,000. He was hosting quarterly client strategy sessions and annual planning meeting retreat at his house. None of that was being structured. So he set up the Augusta Rule structure. So his S Corp rented the home from him 12 days a year for documented client retreats and planning sessions. These were at fair market rates comparable to local co-working conference space in his metropolitan area. The annual tax saving was $21,600 as a business expense. He didn't add a single expense to his business. He didn't change what he was already doing. He just captured the deductions that were always deductible and available. The Augusta Rule isn't for everyone. You need to entertain or use it for real business purposes and make sure it's fair market rental rate that you can document. Post those for 12 to 14 days. But for owners who meet the criteria, it's one of the cleanest tax-free income strategies in the code. No reporting, no depreciation recapture, just income that the IRS never sees. Strategy number 7, hiring your children. If you, assuming you have family and children, number 7 is hiring your children. This is the strategy that sounds too good to be true until you see it work. And it works for one reason. The IRS says income earned by your child is taxed at the child's rate, not theirs, or I mean, not yours, theirs. And if your business is structured right, wages paid to your children also become deductible business expenses for you. And depending on the entity, the wages may even avoid certain payroll taxes altogether. Here's how it works in practice. If you're a sole proprietor or a single member LLC, where you and your spouse are the only owners, wages you pay to your children under 18 are exempt from FICA, Social Security and Medicare taxes. The wages are deductible to your business. They're taxable to your child at their rate, which is usually 0% up to the standard deduction. For 2026, the standard deduction for a single filer is $15,750, meaning a child can earn up to $15,750,000 a year and owe zero federal income tax. The work has to be real. The IRS wants hours logged, task documented, wages reasonable for the work performed. Filing a time card is not good enough. The child has to actually do the work, like filing, organizing, sweeping the office, updating a website, posting to social media, helping with inventory, answering the phone during summer break. I'll give you a real example. A sole proprietor in Indiana named Rick runs a $1.4 million commercial cleaning business. He hired his 16-year-old daughter for 20 hours a week during summer and 10 hours during the school year. The wages were $14,200 for the year, paid through payroll. The wages were deductible to the business, saving Rick roughly $5,000 in federal and state income tax alone, because the business was a sole proprietorship with no other employees in his household. The wages also escaped FICA, saving him another $1,086 in employer payroll tax. Then we took the strategy one step further. Rick put $6,000 of his daughter's wages into a Roth IRA in her name. She has earned income now, and she qualifies. That's $6,000 gross tax-free for the next 50 plus years. By the time she retires, depending on the growth, the one summer of work could be worth like $200,000 to $400,000. Think about that. And not a dime of it gets taxed on the way out. Total first year savings for Rick from this one strategy was about $13,000, plus a starter retirement account for his daughter that compounds for the next half century and teaches her something about money. He didn't add headcount. He didn't change what his daughter was already doing around the house. He just structured it right. So the rules are tighter if you're an S Corp or a partnership. The under 18 FICA exemption doesn't apply unless the business is owned solely by you and your spouse. But the deduction still works, and there's still a real tax benefit. The trick is to make sure the wages are reasonable, the work is real, and the structure fits your entity. So 7 strategies. 5 you've probably heard of, 2 you probably haven't. Together, they account for the majority of tax savings. We deploy and show their CPAs for the owners doing 500K to 50 million in revenue. Most of them apply to your business that you have. Most of them are strategies you're already paying for, just not capturing the tax benefit of it. So here's what I'd ask you to do. Don't try to figure out which of the seven applies to you on your own. Most owners guess wrong, and the answer is usually not what they think. We build a 3-minute tax check that asks the right questions about your entity, your property, your equipment, and your team, and also your family situation. Then it tells you which strategies likely apply and what they're worth in your numbers. The link is in the description below. It takes 3 minutes. You can also schedule a strategy session so we can ask you questions and you can understand. And it's real quick. How a strategy might affect your business and whether it's makes any sense to delve into it further. So this has been Mike Wright with Foresight Wealth Advisory. Have a great day.